Cryptocurrency has evolved rapidly from a niche digital asset to a global financial phenomenon. However, as its popularity and adoption have increased, so too has the need for clearer regulation. In the United States, lawmakers and regulatory bodies are working to create frameworks that will ensure the security and stability of the crypto market. This video explores the top 10 ways crypto regulation is evolving in the US and what businesses and investors need to know. 1. Increased regulatory oversight by the SEC. The U.S. Securities and Exchange Commission (SEC) has ramped up its scrutiny of cryptocurrencies. Initially, the SEC focused on initial coin offerings, ICOs, and whether certain tokens qualified as securities. As the market has matured, the SEC's attention has expanded to cover a broader range of crypto activities. Now, the SEC is more focused on ensuring that crypto exchanges and platforms operate with the same transparency and accountability required of traditional financial institutions. 2. Crypto as a commodity. The CFTC's role. While the SEC focuses on securities, the Commodity Futures Trading Commission, CFTC, has increasingly been taking responsibility for overseeing cryptocurrency as a commodity. This includes the regulation of futures contracts and derivatives related to crypto. The CFTC's role is critical as it ensures that crypto markets remain fair and that investors are protected from manipulation and fraud. 3. Stablecoin regulation and oversight. Stablecoins, digital assets pegged to fiat currencies like the US dollar, have become a central focus of crypto regulation. As these coins are used for everything from trading to remittances, regulators have begun to explore how they should be classified and what level of oversight is necessary. The U.S. Treasury Department and the Federal Reserve are considering creating regulations that will ensure the stability and safety of stablecoins in the financial system. 4. Taxation of crypto transactions. The Internal Revenue Service, IRS, has long classified cryptocurrencies as property, but new rules are emerging to ensure that crypto transactions are adequately reported for tax purposes. This includes more stringent reporting requirements for crypto exchanges, which must now provide users with detailed tax documents. The IRS is also focusing on the taxation of staking rewards and crypto airdrops, seeking to prevent tax evasion in the growing market. 5. State-level regulations. A patchwork approach. In addition to federal regulations, individual states are introducing their own crypto laws, creating a patchwork of regulations across the country. States like New York, with its BIT license, and Wyoming, which has embraced crypto-friendly legislation, are leading the way. However, this inconsistency in regulation has created challenges for businesses and investors, leading to calls for a unified, national framework. 6. The role of the Federal Reserve in digital dollar development. The Federal Reserve has been researching the concept of a central bank digital currency, CBDC, or a digital dollar. A digital dollar would be a government-backed cryptocurrency that could coexist with existing fiat currencies and be used for a wide variety of transactions. While it's still in the research phase, the potential introduction of a CBDC would have a profound impact on the regulatory landscape of cryptocurrencies in the U.S. 7. Anti-money laundering, AML, and Know Your Customer, KYC, requirements. With growing concerns over the use of cryptocurrencies for illicit activities such as money laundering and terrorism financing, U.S. regulators are enhancing AML and KYC rules for crypto exchanges. These requirements are intended to ensure that platforms know their customers and monitor transactions for suspicious activity. The goal is to integrate crypto businesses into the existing financial system's regulatory framework to prevent illegal use of digital assets. 8. Increased enforcement actions. As part of their regulatory push, U.S. authorities are ramping up enforcement actions against crypto businesses that fail to comply with existing regulations. This includes actions by the SEC, CFTC, and other agencies against companies that mislead investors, engage in fraud, or fail to register properly. The increased enforcement signals to the market that the U.S. is serious about maintaining regulatory control over the crypto space. 9. The SEC's approach to initial coin offerings, ICOs. While the ICO boom has slowed in recent years, the SEC remains vigilant about the potential for fraud and manipulation in this area. The Commission has issued clear guidance that many ICOs are subject to the same securities laws as traditional investment vehicles. As a result, businesses looking to launch ICOs must ensure they are in compliance with SEC regulations, including registration requirements and investor disclosures. 10. Regulations on crypto mining and environmental impact. With concerns over the environmental impact of cryptocurrency mining, particularly Bitcoin, U.S. regulators are starting to focus on this sector. Some states, such as New York, are considering regulations that would limit mining operations based on their energy consumption. At the same time, crypto businesses are exploring ways to adopt greener mining practices, which may prompt new regulations designed to reduce the carbon footprint of the industry. The evolving landscape of cryptocurrency regulation in the U.S. highlights the need for clear, consistent, and comprehensive rules to protect investors, businesses, and the broader economy. As the crypto market continues to grow and mature, regulators are working to strike a balance between fostering innovation and ensuring market stability. The next few years will likely see even more changes as regulators fine-tune their approach to digital assets. For businesses and investors, staying informed and compliant with these evolving regulations will be essential for navigating the future of cryptocurrency in the U.S.